Hello everyone, welcome to your YouTube channel, and in this video I will be talking about things you should not be doing when or after you invest in mutual funds. So before I begin today's session, if you are a first time subscriber, if you are a first time viewer of my channel here, please do like and subscribe. Please do subscribe if you are interested in stock market updates, and please do like our videos to encourage us, and because we make videos every single day related to stock markets, investing and finance. And we also have a free telegram channel which you can which you can join. I do post live stock market updates every single day. So let's begin today's session. So markets going down, and you do not know what to do once you have started invested in mutual funds. So here is the top three things which I would say which you should be careful about, and you should not be doing it when um, after you have invested in mutual fund. So the first thing is, do not stop your SIPs when the returns turn negative, because stock markets keep going up and down, and it will not go in one direction only. This is something which you have to specifically keep in mind, because stock markets are subject to market risk. Yes, and it's a combination. It's like a wavy pattern where it will go up and down, and that's the nature of stock markets. And you should never ever stop your SIPs, the systematic investment plans, when the returns are negative. So over a period of time, you will see your returns positive, very positive, and then turn into negative too. But your whole idea of investing in mutual funds is long-term wealth creation, and this requires a long-term investing horizon. So that's something which you have to keep this mind every single time, before and after you have started investing in mutual funds. So the second point which you have to know is, I'm sorry, I think I just copied it. Yeah, don't let your SIP amount remain the same every year. So once you have started investing, the very first thing what you will do here is 500 to 1,000 rupees, or based on your capability, you start investing as an SIP. What many people fail to realize is they keep on continuing with the same amount every year, which is not the right way of investing in mutual funds. Now, if you see a lot of mutual fund returns over a long term, you will see 1,000 rupees or 2,000 rupees investment will turn into crores after a period of 25-30 years. If you want to overcome this, if you, most of the I'm pretty sure that most of the people who are watching are not have not started investing at an early age, like 20 or 25, which should be the ideal way. I know, but many people would not have started investing at that time, because that's the time when you get a new job and things like that. So 90% of the people would not have started at that time. So there is no point in showing a mythological figure of 1 crore or 10 crore by investing 5,000 to 10,000 rupees per month. The best way to overcome that is to increase your investments every year. So if you have a mutual fund where you have invested in 500 rupees every year, you can either invest 750 or 1,000 rupees based on your capability and the performance of your funds. This is extremely important, because if that's the only way you can actually beat time, because time is the key here. You go ahead and invest for a long term, and if you are investing with the same amount over a period of time, the returns may not be enough based on the inflation rate, which is going high too. So this is extremely important in long-term wealth creation. Third, but very important point is, do not chase returns. Now this is very extremely important, as you can go with the first point here. The whenever you uh, put an SIP, you will see ups and downs on the market, and based on that you will actually be thinking about the returns what you're getting in 1 year, 2 year, and things like that. If you have taken a decision about going ahead with a particular fund for approximately 5 to 10 years, and if the fund is consistently performing well, that means um, it has not drastically changed, then I think you should not be looking at the returns in the short term. Many people have this habit of seeing returns after 1 year, 1.5 years to how the fund is performing, and based on that, they take a decision about changing that fund, which is not an ideal way of investing in mutual funds, because mutual funds um, make great wealth, a good amount of wealth in long term. But a short term returns, if you are looking for short term returns, mutual funds are not the way of getting short term returns. Now, to to uh, to to make you understand better, if you are looking for short-term gains, then you should definitely learn some conservative option trading strategies for short-term returns, and also some other investment ways through from which you can actually have some short-term gains. But mutual funds are definitely not for short-term gains. So that's pretty much, these are the three important and top three things which you should keep this in mind before and after you have invested in a mutual fund. So hope you enjoyed this informative video. If you have any comments, questions, or clarifications, feel free to comment on the description on the video below, and I'll be happy to go through it, because I do read all the comments and reply to each and every comment. If you have not liked this video, please do. You can press the dislike button, but I would suggest please also do give me a feedback as to what part you didn't like, so that I can make the videos better in future. So thank you, and I will see you again on my next video.